battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 43 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. We're back. We're up to episode 161. We got producer Owen back in the saddle. We are hitting it hard here. Can't believe it's September, rolling our way into Investor Day 2025. Don't forget, it is our last event of the year, best one ever that we're going to probably have so far. And Dr. Ed Yardeni, the legend of Wall Street, coming in person. We got Andrew Opdyke from First Trust. We got the Family Office panel, which was one of the most highly rated sessions of last year's Investor Day. So you can't miss this thing. This is the last time I'm going to talk about it. We already are at like 90% capacity now. So I told you this thing was going to get full quickly. It's already September. Thing is in November. So this is your last chance to register. If you're thinking about it, you've been listening every week on the show, you've just been putting it off, and you haven't registered yet, this is your last opportunity. There will be one final email that goes out next week as a reminder, last chance to register, and then we're going to a waiting list. So don't miss this thing. We do have limited capacity at the hotel. We're going to try and find another venue for next year so we can get many more people in person for this thing, but we are almost at capacity. This is your last chance to register, Investor Day 2025. So get it on the books. If you need to take a day off of work for this thing, I highly recommend it. Save a day. Pretend like it's a holiday. I mean, Investor Day 2025, just put it on your calendar. Say, hey, boss man, I can't come into work today. I got to go to Investor Day. So why? Because you're going to get the clarity and the confidence, the good news, the reasons why you got to stay on your plan. And if you're listening on Apple or Spotify, watching on YouTube, please hit subscribe. Helps us get the show to more and more people. So appreciate you coming back each and every week. It means the world to us. Episode 161, the good, the bad, and the ugly. We're going to talk about that. It is also NFL Week 1 already kicked off yesterday. It's Friday as we're recording this, September 6th. Tis the season. It's football season. In the past, we've seen the three Midwest teams, the Bears, the Packers, the Vikings, kind of go at it, friendly rivalries. I had a friend growing up in grade school who had a shirt that said the Vikings were the good, the Packers were the bad, and the Bears were the ugly. That might be reversed this year. So looking forward to seeing the Bears kick it off pretty strong here. If you've been watching that, is it HBO Max, producer Owen? We've been watching the Bears documentary. What's it called? Hard Knocks. Tremendous. Highly recommend. Did a nice job there. But it's that time of the year. So can't believe it. It's already football season. I'm going to break down the economy and the stock market for you today in the same way. The good, the bad, and the ugly. Hopefully the Bears this year are in that good category. We'll see what happens. What's the good in the economy right now? Well, number one, it's corporate profits. Corporate profits are still very strong. They are kind of in a lag. They're not a leading indicator, corporate profits. They're sort of a lagging indicator because it's whatever happened about a year ago, maybe even 2 or 3 quarters ago, is showing up now this quarter. And so you can't always say corporate profits are gonna impact what's coming next year, right? But what happens in the stock market is the stock market's level, the S&P's level in particular, is a leading indicator because it's going to tell you this is what we expect to happen with corporate profits next year. So far, corporate profits are really good. And I expect corporate profits to stay strong if we get into a recession, which I still think is a ways out. I don't think we're quite at that point yet. And we'll talk about why that is. But if we do get into a recession, obviously corporate profits will take a dive. In a mild recession, they go down about 9%, not the end of the world, but they do go down, obviously. If you see a major recession, you see corporate profits go down about 18% on average. But we're just not at that point yet. And so we still are projecting on Wall Street about $310 in earnings for 2026. Why do I talk about 2026? Because again, the market's this discounting mechanism. So whatever the market is at today is this window into what's coming in the future. And so at the end of 2024, we're already trading on the expectation of 2025, which, by the way, we're not that far away from the end of this year. It's hard to believe. This is already, I think, week 36 or something like that of the year. So next year, at the end of 2025, we're going to be trading on 2026 profits. And that's why I start talking about 2026 earnings, which it's a hard thing to estimate. It's hard to understand exactly what's going to happen. That's a lot of time between now and the end of 2026. But the reality is profits are probably going to be up on the S&P. Yes, we may have a dip in the short term, but most analysts on Wall Street, even the most bearish ones, have still said profits are probably in that 300, 310 range. What they're questioning is the value you place on those profits, depending on what interest rates level out to be. Now, the 10-year Treasury is dipping down to 3.6%. And the Fed is still at 5.25 to 5.5. We're expecting to get a rate cut. We'll see what happens. I don't think the Fed's going to cut rates fast enough, which can be problematic in the short term for valuations. And that could be a reason why we have a little bit of a continued correction. Right now, the S&P is down about 4% from its all-time high. Not a reason to panic. I've been telling you this. In fact, tomorrow's news today, we tried to tell you what's coming. I told you at 5650, the S&P was due for another pullback. And sure enough, here we are. S&P's down about 4%. Not the end of the world. It's not something that you should be panicking about. And in fact, I do think we're going to see maybe another 3, 4, 5% downside before this thing is over. Maybe we trade the S&P around 5,100, 5,200 points. But when it's all said and done, we're going to go back to corporate profits. And corporate profits for 2026 are looking pretty good here, around $310. Multiply that by 20. And you're trading the S&P north of 6,000 points. And so that's one of the good points of what's going on. The other thing, too, a lot of bearish people are pointing to the fact that credit card debt is rising. That is true. Student loans are pretty high as a portion of consumer balance sheets. That's true. But one of the biggest contributors to consumer debt is mortgages. Mortgages are actually at a low point, all-time low. Why? Because people fixed their mortgages in 2020, 21, and 22 at rock bottom levels. And so we've never had as many people, as many consumers as we have today who are sitting literally on zero mortgage. We've never had a point in history in the U.S. where more homeowners have not had a mortgage at all. Plus, the average fixed rate loan is hovering around 3.5%. That's 30-year money. And so if you started that loan in 2020 or 2021, you still got 25 years to go or 26 years to go before that thing's going to get paid off. It's a problem for supply. And what the Fed is doing is they're keeping rates, I believe, my opinion, too high. The 10-year Treasury is already pricing in the 10-year at 3.6%. The bond market is telling you interest rates are eventually going to come down. The Fed thinks they lead the bond market. And in fact, it's the other way around. The bond market actually leads the Fed. The Fed is always behind the 10-year. And so right now, if the 10-year is 3.6, 3.7%, you can expect. Does it happen next year or the year after? I don't know, but you can eventually expect the Fed to get down to that 3.6% zone. The average spread on a mortgage is 1.25% to 1.5%. On a jumbo loan, it's about 1%. So as time progresses, you're going to see jumbo loans priced at 4.6%. You're going to see a standard conventional loan priced at 5.15 or 5.2. And I think if we can get mortgage rates down to that 5% zone, just psychologically for a lot of consumers, they're going to say, okay, 5% isn't 2.5 or 3% like it was in 2020, but it's not as bad as 7 or 8, which is where we kind of peaked out at a few months ago. And so I think that's going to be a huge catalyst to getting the housing market going again. But the good news is mortgage debt is still very low. This is a very important thing for the consumer balance sheet. And because of that, the consumer is largely still okay. And I was saying last year that the consumer was abundantly strong. I think we're seeing some cracks. We're seeing some weakness happening here. But for the most part, consumers are still okay. You got to be careful with these reports you see, like Dollar General, who came out and said, oh, our consumer's falling apart. Our consumer can't even afford day-to-day items at the Dollar General. Now, it's not all $1 anymore like it used to be. It's like $4, $5, $6, $7, $10. But they're saying, hey, there's weakness in our consumer, which some people are saying this is bad news. This is a real problem. If Dollar General's consumer is having issues, what's going to happen to the rest of the economy? But that's only one part of the story. Look at Walmart. Walmart this year is up 44, 45%. And so what are consumers doing? They're chasing value. That's just what consumers do. That's what they've always done, is they go after more value or perceived value. And right now they're not seeing it. The consumer is not getting that value from the Dollar Generals of the world. They're getting it from the Walmarts of the world, the Amazons of the world, and spending at those places is off the charts. And so be careful which narrative you listen to. If you get caught up in this narrative that Dollar General is bad, so the world's falling apart, you're going to miss the broader story that there is this difference in the type of consumer out there and where consumers are going in general. You've seen the same thing happen with McDonald's here. McDonald's is having some weakness in 2024, although making a little bit of a comeback the past couple of weeks. But you could say, hey, McDonald's is falling apart. This is going to be a real issue for the rest of the economy. And that could not be further from the truth. If you look at Chipotle, for example, Chipotle stock, even after having a correction the past couple days, is still up 20% for the year. That is good news for the economy. So, what are consumers doing? Well, it's what they've always done, which is chase value. So, it doesn't necessarily mean the consumer's falling apart right this second. It just means preferences are changing. And so that's okay. And so that's why I say the consumers are still doing okay. I put that in the good category of where the economy is at today. Now, the last part of the good news is the fact that we are expecting at least at a minimum divided government in November. We're quickly approaching this next election and just a couple months out now. And I believe if the market really thought that Kamala Harris was going to be president, the Democrats are going to be in the House and the Senate, you would see a major sell-off in the stock market. We're just not seeing that happen. We should be down 20% if that was the case. We're not down 20%. We're down 4% from the all-time high. And it's like Nate Silver has pointed out, which, by the way, you can hate me for saying this, but Nate Silver is actually a Democrat on the left side of the political aisle. He does these statistical analyses and projections of what's to come in the next election cycle. Nate Silver says, listen, it always comes down to the Electoral College. You can love it or hate it. It's not about the popular vote. It's likely that just like in the last election where Trump ran against Clinton 2 elections ago, rather, Trump lost the popular vote, Clinton won, but Trump won the Electoral College. That's all that matters. And so when you start looking at those numbers, Nate Silver says there's a good chance Trump actually wins the Electoral College over Kamala. I'm not endorsing anybody. I'm not telling you what I want to happen in the election. So please don't be upset with me. I'm just telling you the math, the data, the statistics. So put your personal feelings on the side. There's a chance that Trump wins back the presidency, but there's even a better chance that even if Kamala Harris beats Trump in the Electoral College, that you have divided government, meaning the Republicans are in the House and the Senate. That's a very good thing for markets. And so again, it doesn't matter what your political leanings are. It doesn't matter what you think or your favorite candidate or anything like that. Just look at policy. Policy is what matters. And the way I can prove this to you is just look at Argentina versus Mexico. Mexico elected a socialist, Claudia Sheinbaum, and their stock market's completely falling apart. By the way, 33 or 34 of their presidential candidates this season were assassinated. So you think things are bad in the U.S.? 33 people literally wiped out in Mexico running for office. Not so great. Wouldn't recommend running for president in Mexico. Not the best idea, it seems like. But look at Argentina. You have Javier Milei, and he came in and he is slashing the size of government. He had all the government agencies on the whiteboard, and he's pulling them off. And he said, "You're gone, you're gone, you're gone, you're gone." Elon Musk is talking with President Trump about opening up a office of government accountability or efficiency, and kind of similar. Made me chuckle a little bit about comparing it to Javier Milei, who did the same thing. But look at Argentina. You can't argue. You may not like Javier, but you can't argue with the results that Argentina's already seen. Inflation is coming way down. Housing prices are coming way down. Why? Because he's getting rid of a lot of the red tape that stood in the way of growth in Argentina. And so one of the big things you saw was he got rid of all the restrictions that you couldn't build and all this rent controls and all these problems that Argentina's faced. And now building's coming back, construction's coming back. If you get rid of rent controls, guess what happens? Places become more affordable because people provide more supply. And that's what capitalism does. There's issues with it. I'm not saying capitalism is perfect and it's wonderful and it never has issues. I'm not saying that. But it's certainly better than all the other systems out there. Why? Because it provides abundance, whereas socialism and communism, been tried in like 110 countries over the years, has never, ever worked. And the people that say, oh, yeah, this is the one, this is the time where communism and socialism are going to work, are fooling themselves. They're not being honest with their voters, because if you actually looked at history, if you opened up a history book, you would quickly realize that that's absolutely ridiculous. You are not going to have prosperity. You're not going to have abundance in communism. Why? Because ultimately the state controls everything you can say, even what you're thinking. And that's really what communists try to do. When you control thoughts, when you control words, that's why freedom of speech is so important. When you start controlling some of that stuff on an authoritarian level, people say, you know what? I'm not going to start a business because if I start it and I'm successful, the government's going to take it away from me. That's called China, quite frankly. And China's having tons and tons of problems. They can't get people to innovate. Surprise, surprise. You throw your best innovators in prison, and then nobody wants to innovate anymore. It shouldn't really be a shocker to all of us. And here's a great quote I found this week from Harry Truman. And I believe this was August 8th, 1950. He said, once a government is committed to the principle of silencing the voice of oppression or opposition, it has only one way to go, and that is down the path of increasingly repressive measures until it becomes a source of terror to all its citizens and creates a country where everyone lives in fear. That was Harry Truman, August 8th, 1950. I think those words are eminently true today. You're seeing this authoritarian push. You're seeing this push towards control, censorship, and trying to shut down the little guy. Why? So that you can control the means of production. That's communism. By the way, the Federal Reserve is a huge part of the Marxist agenda, because once you control the money supply, you pretty much can control everything else. And that's why there is such a push right now against free speech. You're seeing the guy who started Telegram. You're seeing Elon Musk have trouble with X. And again, I'm not endorsing any of these people. I'm not saying we love every single thing these people do. But if we want to live in a world of prosperity where entrepreneurs innovate and create wealth, we have got to maintain free speech. We've got to maintain our ability to think freely. And if you don't have that, you wind up in basically what Mexico is headed towards, what China has been in for decades now, North Korea, of course, and we just can't have that if you want prosperity. So the good news is I don't think we're going to head towards full-blown communism here in November. I think we're going to have divided government at a minimum, and that's good for markets. So here's the bad stuff that's going on in the good and the bad and the ugly. The bad stuff right now is there is this separation between the best and the rest. And I'm talking about the distribution of companies. You're seeing more and more companies that are already strong continue to get stronger. You're seeing the weakest really start to have some serious, serious problems. And one of the examples that I've been using when I talk to clients is Traeger. My wife bought me a Traeger for Father's Day this year. Had a great time. We made a couple of pork butts. We made some ribs, made a chicken. It was great. I'm interested in how Traeger's doing as an investment. I was just curious. So I looked it up, did some research, and here you have Traeger making grills and smokers and, grills, things like that. And they took out $440 million in debt during COVID to make grills. And you're going, guys, you just want to shake their management team and say, what in the heck were you thinking? $440 million to make grills? Are you nuts? Are you out of your mind? This is crazy. And so far, Traeger is suffering as a result. If they didn't have the debt, they'd actually be quite profitable. That's the problem with a lot of these businesses that, in my opinion, were mismanaged during COVID. They took on debt. They took on tons of debt to be able to finance expansion. They didn't realize that the rates were going to rise, which they did, of course. And now they're paying the price on their income and cash flow statements. This is a real problem for the bottom 1%. Compare that to, and I'm not recommending any of these names. I'm just using them as examples. So don't hear any of this as investment advice. But a company called Vital Farms. Vital Farms is doing sustainable farming. They do organic eggs, pasture-raised chickens, all this stuff that's great, regenerative farming, and they've just had some explosive success since they've started. Vital Farms has no debt. And yes, they are having some weakness in their stock price on a short-term basis. But when you look at their income statement, their cash flow statement, at least they don't have all this money going to interest payments. And the same thing goes for households. When you have a household that is saving for a rainy day, that doesn't have tons of leverage, that isn't taking on 3 or 4 car payments, that isn't taking on a boat loan payment or buying a second home on a massive interest rate, when you have a strong balance sheet household, when the bad times come, which you know they're going to come, it's not a matter of if the bad times comes, it's a matter of when. When the storms come, the house that's built on the rock, which we've compared, we've used that example many times in the past couple of weeks, the family built on a rock of a firm foundation of low debt and strong cash is going to be fine. You're going to make it through the other side alive, but it's the ones that are highly leveraged, the families that do not plan for a rainy day. Same thing with the companies. When the bad times come and the tide goes out, as Warren Buffett says, you find out who's swimming naked pretty quick. And that's what we're starting to see. Interest rates are that great refining fire. When you see interest rates at the level they are today, you're seeing who the best versus the rest is. That's the bad part of what's going on. And so that's why I continue to say, watch out for quality. If you have a high quality company, it's not a guarantee that everything's going to work out and you're going to get a return. So that's not true at all. There's no guarantees in the stock market. But from a probability standpoint, you have a much better probability of success owning high quality in a bad time than owning low quality. I know this sounds very obvious, but it's not as obvious as you think. When you look at home office cookie cutter portfolios, we see these things all the time. I'm not going to name any names, but we had a statement come in the other day. This is a pretty common thing. Actually, yesterday, a statement came in from a different financial advisory firm. If I told you the name, you would know it. And the return has been 5.35% the past 2 years annualized. The S&P has been 16% the past 2 years annualized. What's the difference? Well, it's quality versus low quality. High quality, good, strong balance sheet companies versus companies that just have not managed properly. And it didn't matter as much when interest rates were low and things were kind of okay and everybody was on this slow melt up. But when the times get tougher, you start to see that massive difference. So that's some of the bad stuff going on. I think Kamala's tax plan is horrible. It's not just bad. It probably would be in the camp of ugly in some ways, especially the unrealized capital gains proposal, which is completely bonkers. If they ever pass that, the stock market would plummet 30-40%. Why is the stock market not plummeting 30-40%? Because the market doesn't expect that to actually get passed. And that's the difference. That's the reality of proposals versus actual policy that's going to get passed. Obviously, Kamala wants to get the capital gains tax rate up. She wants to get rid of the lifetime estate exclusion for estate planning tax purposes. And she also wants to increase corporate tax rates. It's all going to slow down growth. It's not going to bring growth to a screeching halt like true communism or socialism would, but it does bring it down. It slows down the rate of growth. And so if you want your portfolio to do well, you want your companies to produce more and more profits so that your prices go up, your portfolio value goes up, you should be very careful about the policy you're voting for, because the policy you're voting for directly impacts company profitability. Remember, the company is not really a person, and the company doesn't pay taxes. It's just an entity. It's a piece of paper. And so when you pass down a corporate tax rate of from 21% to 28%, for example, to these companies, you're actually passing down that input cost, that taxation to the end consumer. And so if you want stuff to get more expensive, if you want companies to be less efficient, if you want less small business formation, if you want less entrepreneurship and less growth and less prosperity, you should vote for all that stuff. If you want more prosperity, if you want abundance, if you want more and more entrepreneurs to enter markets and create businesses and grow wealth for the rest of us, then you should want lower taxes, lower regulation. I'm not saying zero taxes. I'm not saying zero regulation. We, of course, have to have red tape, rules of the road, stoplights, stop signs, all the rest of it. Of course, that's just part of a functioning democracy, but and rule of law and personal property rights. But if you go too far with some of that stuff, then what you do is you slow down innovation. And so that's some of the bad stuff out there. Let's talk about the ugly. And this is some of the data that's underneath the surface that the media just refuses to report on. And so I'm going to report it because I think it's really important. Number one is trucking and shipping activity are starting to decline pretty significantly. You're seeing some weakness in the trucking sector. That is a leading indicator. You're seeing some manufacturing data weakness. It's not horrible. It's not awful. I'm not trying to sound the alarm bells here, but it is starting to slow a bit. We are seeing manufacturing. If you look at the ISM is now hovering at 46.8%, which is a 1.7% decline from June. So not fantastic, not horrible, but it is declining. We are seeing some weakness in manufacturing. But the big one, and this is probably the ugliest part of where the economy's at right now, is the unfilled jobs report. If you look at the number of unfilled jobs, these are companies looking for workers, job openings, non-farm payrolls. We are actually down now almost to, let's pull up the data here, almost down to the levels that we saw in November of 2018 at about 7.7 million unfilled jobs. We peaked in 2022 when interest rates were zero at 12.1 million unfilled jobs. We're back down to 7.7 million. The all-time high in 2018 was 7.6 million. And so is that recessionary? No, of course not, not yet. But that is a leading indicator that there could be some issues, some cracks emerging in the economy. The White House is never going to talk about this. It's not in their best interest to mention that there's some weakness in labor. And there's a mismatch between the Fed and interest rate policy and what's actually trickling down into the economy, because the Fed's always on a lag. And so on the front end, the Fed waited too long, in my opinion, to raise interest rates. They should have at least been 1 or 2%, not zero in 2020 and 2021. So they lagged on the front end, then inflation spiked way up. Well, now they're lagging on the back end. They've raised rates, and they probably should be cutting already. But because they're on a lag, you're not going to feel some of the effects of higher interest rates in the economy still for a couple of months. I can tell you, boots on the ground stories, there is slowing in the labor markets. There's no question. I've had a couple of my clients who have been laid off from their jobs, great jobs that they never thought they'd get laid off from. They're getting laid off. They're trying to go look for work. Some have been looking for 3, 4, 5 months, and it's getting very, very tough to find something equivalent to what they would like to be hired for. The tech sector is starting to pull back. Some of this is a normalization back to reality, back to the longer term averages. You're getting some mean reversion with the labor market because we had such a great labor market in 2022. But some of this, if it goes too far and the Fed doesn't pivot quickly, we're going to end up in some trouble. And the trouble could be in 2026, 2027. It could take a little bit. That's why I'm telling you, don't panic. Don't do something stupid today with your stock portfolio, with your investments, thinking that something bad's going to happen in 2026, 2027. You're not going to be able to time this thing successfully. I'm just warning you that because of some of this under the radar weakening that we're seeing in the data, it's possible we trade the S&P at 51, 5,200 in the short term. So just be mentally prepared for this. It is a possibility. That would be a 9 or 10% correction from the all-time high. Don't forget also that September and October can be historically weak months in the market. That's very typical. The media is going to spin this as, oh, here's the 10 reasons why we're seeing weakness this month or next month in October. But the reality is these are just historically weak months. It's also not the best time in the market going into the election. Why? Because there's some uncertainty. And that's part of the reason why you're seeing these unfilled job numbers decline. And that's why you're starting to see employers get a little bit tighter with their budgets. They're saying, look, we don't know what's going to happen in November. We don't know what's going to happen next year. We think that things could be a little bit weaker next year than they are today. And companies are incentivized to be a little bit bearish, to be a little bit cautionary. Why? Because they'd rather surprise on their earnings. They'd rather surprise you next quarter and say, actually, things were better than we thought, than the reverse. They'll get punished in the stock market if they miss earnings. And so you're starting to see just a little bit of caution. That's not a bad thing. But when it comes to short-term market returns, it can drive markets down to that 51, 5,200 point zone in the short term. So just be prepared for that. Just be aware of the fact that we don't go up in a straight line forever. There are declines in the short term. There are corrections. Now, after November, once you get through the election, markets should do just fine, especially if we get divided government. Maybe you get a Republican sweep. Stock market is going to do just fine. And historically, going into the first year of the cycle, that's next year, the first year of the 4-year cycle, we should have some pretty strong returns after the market gets certainty. And that's what markets always want to see, is certainty, not necessarily good news, bad news, or anything like that. Bad news is not great, of course, but more so certainty. We can deal with bad news, but we've got to know what it is. And the easiest example of that was in 2020 when we had COVID happen. Remember, the stock market dropped 30, 40% in 2 weeks. It was that quick. It was just like a flash crash. Market was down 40%. Why? Because markets didn't know what to expect. We didn't know if the economy was still going to function. We tried to turn everything on and off like a light switch, and markets panicked in the short term. But by the end of 2020, the stock market had actually produced a double-digit positive return, one of the best years we've ever had in the stock market. Why? Because now we had some certainty, and we knew 2021 was going to be a recovery year, and certainly that's what we had. And so that's what I would focus on, is focus on the next couple years. You are not going to be a successful investor if you get worried about next week's news or November's news or next month's news or anything like that, or the black swan event that comes up that none of us see coming. You're going to be a good investor. You're going to be able to stay on your plan if you look at a 2, 3, 4-year time frame and have some perspective on where we've been. Remember, the all-time high peak S&P value in 2021 was 4,750. So even if we correct to 5,200, you're still up if you stayed on your plan. And once we get through some of this seasonal weakness, once we get through some of the bad news that may be coming, once we get through November, I believe we're going to trade the S&P at 61, 62, maybe 6,300 points. It's just a matter of when. So don't panic. Don't do something dumb today with your portfolio. Just stay on your plan. Stay on the course that we've charted out for you. If you don't have a plan, you better get one. You better call a good fiduciary financial advisor. Give us a call if you'd like. Call somebody else that you trust, somebody that you could work with to get a plan together for you that's time tested, that's goals based, that says here's what our long-term goal is, not to run out of money in retirement. And once you solve for that goal, and once you figure out maybe we're going to go on a trip, maybe we're going to buy a car, maybe we got a wedding to pay for, college tuition, those are the midterm goals. Once you figure out all that stuff, you don't have to be a reactionary investor. You can be proactive, planning ahead, getting your investments on a long-term goals-based financial plan. And if you do that, you'll be just fine. You will make it through any downside that we're going to see maybe the next couple weeks and next couple months. So I encourage you to stay on your plan like always. Like the show, subscribe to it, share it with your friends and family, get them the clarity and confidence, the good news that they need to stay on their course. We'll be back with you next week for episode 162. Thanks for being here. We'll see you next time.